Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of CA Final SFM, we are talking about the main topic derivatives, and within derivatives we are going to discuss about futures contracts. Within futures contracts we will begin our discussion with what is arbitrage. Arbitrage, what it is, how does it work, how someone can make arbitrage gains, how to find arbitrage opportunities, how to use the concept of pricing for determining the fair value of the futures, and all the interrelated concepts. We are going to discuss each of these points one after the other. So let us have a pinpoint focus on what exactly is arbitrage. Arbitrage is a wonderful thing. It is a concept of making profits without taking risk. If you can remember, in the previous session of derivative, I have told you that the participants in the derivative market could be three types of participants: hedgers, speculators and arbitrators. Hedgers are those parties who would want to avoid risk. By incurring even some cost, they would be happy to avoid the risk on them. Speculators on the other side are parties who are willing to take risk just for making money in the stock market and derivative markets. And arbitrators are basically yet another category of participants who wants to make money without taking any risk. Now, by listening to this line, it appears to be so lucrative, right? Making profits without taking any risk. But that is the beauty of this concept, arbitrage. You make gains without taking any risk. So, obviously, this is going to be a wonderful technique of participating into derivative market, where we will not be taking any risk at all, but we can still make assured profits. If there is a scenario where if we proceed ahead and we incur loss, we will not just go for it. We will make sure that we make secured profits and definite profits. That is all about arbitrage. So in one line, if I have to tell you meaning of arbitrage, I would simply say making riskless profits. And if you ask me how to do that, it is one simple thing: buy something in one market and sell the same in the other market, but at such a price that you make the differential as gain for yourself. And this should happen in such a way that you are getting an assurance of profit without taking risk. So in one line we can further write, it is indicated by buying something from one market and selling the same in the other market. Now, we are not going to buy and keep it, because if we do that, it is not an arbitrage transaction, it would be an investment. We are not here to make investments. We are here to make arbitrage, and arbitrage would necessarily work when one side, in one market you make a buy transaction, in other market you have a sell transaction. Buying and selling. Buying from one market, selling in other market. At that too at different prices, and you are getting an opportunity to make riskless profit. To understand the whole scenario, how it would actually work, let us take some calculative examples initially. The first very small simple example that I will take will be highlighting simply one thing, that is the concept of the arbitrage, where we will have different kind of strategies depending upon the situations, and gradually we will go deeper into the pricing of the futures. When we go for pricing of the futures, it will be technically, it will be involvement of continuous compounding concept and other interrelated situations and concepts. So let us have all our discussions one by one. So your attention on the screen, and I take you to certain important calculative examples. Let us read what is given in question number 1. Price of share of X Limited in spot market is rupees 400. Rate of interest prevailing in money market is 10% per annum compounded annually. Determine the fair futures price and indicate if there is any arbitrage opportunity. If yes, determine the arbitrage strategy and explain the process of arbitrage under the following situations. Number 1, actual futures price for 1 year is rupees 460, and number 2, actual futures price for 1 year is rupees 420. Now friends, in this simple scenario, let us first try to understand how exactly do we deal with this whole example. The focus point is the price of the share prevailing in the spot market at present. It is given as rupees 400. The immediate next thing that we have to look into is the interest rate that prevails in the money market. So interest rate prevailing in the money market is given as 10%, because we may have borrowings or investments in money market for a maximum period of 1 year. So what we will observe is two basic information: the spot price of the share in the stock market and interest rate prevailing in the money market. So spot price is given as rupees 400 over here in this example, and the interest rate is given as 10%. So first what we will do is we will determine a fair futures price, having a simple notion that if an investor would want to make investment without taking any risk, for that the investor has to approach money market. Money market is a market where there is absolutely zero risk of making investments. You make investments and you get back your money with the stipulated interest payments, no risks at all. So money market rate can be considered as a risk-free rate. So if an investor is investing rupees 400 today with 10% interest rate prevailing in the money market, the maturity value of this investment after 1 year will be simply 400 plus 10%, that will be 440. So 440 will be considered as the fair futures price. I repeat, 440 will be considered as a fair futures price. That means the fair price after 1 year should be 440. Now look into what is the actual price quoted in the futures market. Actual price quoted in the futures market is given in two different cases. Case 1 has conveyed over here 460 and case 2 is stating 420. So none of these are matching with 440. The point is, once you determine fair futures price, you compare that with the actual price prevailing in the futures market. If it is matching, that means if fair futures price and actual futures price are same, there will be no arbitrage opportunity. However, if there is a difference between the fair futures price and the actual futures price, arbitrage opportunity definitely would exist. Now whether the actual price is more than the futures price or less than that, it will not make any difference. In either scenarios you will be finding arbitrage opportunity existing. So let us do one thing, let us deal with each case one by one. So let me first explain you before we go for the solution of this question. Can you notice one thing? The first case given over here, it indicates that the actual futures price is 460. Now use your simple common sense. We have determined the fair price of the futures contract to be 440. The actual price quoted in the futures market is 460. That means whatever should be the price, 440, the actual price is more than that. We call that situation as the stock is overpriced in the futures market. I repeat, the stock is overpriced in the futures market. Anything which is overpriced, what we would do? Anything which is overpriced, what we would do? We would simply want to sell. So what I will do is, I will enter into a futures contract to sell that stock at 460 because that is the quoted price. And we have seen in the previous session, if you have missed the previous session, I strongly recommend you to watch that first, because without carrying forward that concept over here, you will not understand where I am taking you ahead. So we have seen in the previous situation, previous class, that when the price is 440 or 460, if there is a difference in the price, to be more specific, We have seen in the previous class that if you enter into a futures contract at a particular price for selling a particular stock, you will actually be able to sell the stock at that price. In other words, if someone enters into a futures contract to sell the stock at 460, no matter after 1 year whatever be the price prevailing in the spot market, the party would simply recover rupees 460 on selling the stock. That is for sure going to happen. How does it happen? I have explained in the earlier class. So once again, the spot price today is 400. Interest rate prevailing in the money market is 10%. What we have done is we have taken a scenario that if someone wants to make risk-free investment, they can approach an investment opportunity in money market by investing rupees 400 today, and which would have the maturity value of 440 after 1 year. That maturity value we have taken as a base and defined that as a fair futures price. Compare that with the actual futures price. In first case, we are finding the actual futures price to be 460, means the actual price quoted in the futures market is higher than the fair price. As a result, if the actual futures price is more than the fair futures price, what you would want to do? You will first of all declare that stock is overpriced in the futures market. You would be benefited only when you sell the stock in the futures market. So in the futures market, you should take a short position. Now, what is short position? And all this I have explained in the previous class. So you should take a short position in the futures contract, and the other market that we are dealing with is the spot market. So I told you arbitrage means selling something in one market and buying the same in the other market, or buying something in one market and selling the same in the other market. So the two markets that we have to deal with over here, one is the futures market, one is the spot market. So in the futures market, if you are taking a short position, in the spot market you have to take a long position. So we would say sell the share in the futures and buy the share in the spot. We will make an arbitrage strategy as sell futures and buy spot, or you can say buy spot, sell futures. If you are making this strategy, you will be definitely making an arbitrage gain. So how will you make that gain? I will explain in details, but let us do one thing first. Let us first understand this much by writing down the whole solution. Now one more thing, throughout the class when I instruct you to write, there will be no additional time given for you to note down things. If you want to write any notes, you can pause the video, note it down, and then you can resume the same. So friends, I am taking you to the first case to be answered over here, that is when the actual futures price is 460. We will first arrive at the conclusive arbitrage strategy, and then I will explain you how to make arbitrage gain by following a simple process of arbitrage. So your attention on screen please, while I take you ahead for the discussion with respect to the arbitrage strategy. So what you can do is, you should first find the fair futures price, which I have already explained to you. It will be the current market price plus the interest element. So in this case, it will be 400 plus 10%, that is 440. And now compare the fair futures price with the actual futures price quoted in the market. So case 1, actual futures price is given as rupees 460. So when you compare, you definitely find that the actual price and fair price, they are different, and therefore arbitrage opportunity exists because AFP, that is actual futures price, is not equal to FFP. So AFP is found to be greater than FFP. AFP is found to be greater than FFP. Therefore, in the futures market, the share is considered to be overpriced, and it will be better to sell the share in the futures market. In order to take the counter position, the share should be purchased in the spot market. Therefore, the arbitrage strategy will be buy spot and sell futures. So friends, quickly take note of this whole thing and then I take you ahead. Alright, I am sure you would have finished writing this whole thing. Let me now explain what has to be done ahead. So what you should simply do now is focus on this scenario. We have already designed a strategy of buy spot and sell futures. What does that convey? You basically should be buying the share at the spot. For that you will need investment of rupees 400 because you have to buy the stock today and you will sell it in the futures market, means you will be selling it after 1 year. So what you should do is, to buy the stock you need money. You first borrow rupees 400 from money market at risk free rate of 10%. So today you borrow 400 rupees and you borrow at risk free rate of 10% for 1 year. The maturity value of this borrowing will be 440. Done, defined. We will repay this loan after 1 year. So it is now clear that no matter what happens, after 1 year we are committed to repay this loan with interest amounting to rupees 440, with interest of course. Now what you do with that 400 rupees obtained as proceeds from borrowings today? You should simply invest that money in buying that stock. So buy that stock and hold it. So do you know step by step what all transactions we have carried out? We have first of all borrowed from money market rupees 400 at 10% interest. Second thing what we have done is we have utilized the proceeds of the same in purchasing the stock. So by doing this much, the buy spot over here, if you can see, the strategy is buy spot sell futures. So buy spot part of the strategy is done. To sell futures means to enter into a futures contract with a short position. That would be the third step. Now what has happened? By end of these 3 steps, you are definitely going to make profit, but not today, only on the settlement date, that will be after 1 year. Why and how? See, you have already entered into a futures contract to sell the share at rupees 460. Now after 1 year, no matter what happens, you will be able to encash rupees 460 by selling the share along with the execution of the futures contract. I am again reminding you, if you have not attended the first part of the derivative, please do that, because over there I have explained how can this be achieved in reality. Now if you can sell the share at 460, so after 1 year when you execute your futures contract, when you settle the futures contract and sell the shares, you will be realizing rupees 460. Compared to that, your borrowings to be repaid, which will be a cash outflow, that borrowings to be repaid with interest will be 440. So you encash rupees 460 from your futures contract and selling the share, and what you have to repay is your borrowing with interest, that is 440. So cash inflow will be 460, cash outflow will be 440. All transactions settled and you end up making rupees 20 as a sure gain. Now rupees 20 would appear to be a small amount, extremely small, negligible amount, because we have taken 1 share for this contract. You may have big multiple. You may enter into 10,000 shares. On each share, if you make a profit of rupees 20, what will happen? If you expand your contract size to 10,000 shares, your overall profit for this whole thing will be rupees 2 lakhs by end of it. Just imagine what would happen if you enter into a contract with 1 lakh shares as the size. Your total gain will be rupees 20 lakhs. Bigger the contract size, the bigger will be the magnitude and quantum of your gain, but gain will arise, that is for sure. However, for computing this gain, we have ignored all the transaction costs. There will be brokerage, there will be some other kind of charges, there will be some legal charges to execute all this. We have ignored all that. Tax arising on this kind of profit, all that has been ignored. We are simply computing the gross amount of arbitrage gain. In examination, if you are getting a question like this, you are going to compute simply the gross amount of arbitrage gain, and that's all. So friends, let us do one thing. Let us see how to present the later part of the answer, that is the step-by-step process of determining this arbitrage gain. So let me take you ahead from here. So arbitrage process will be step-by-step structuring of the entire strategy. So first step will be to borrow rupees 400 for 1 year at risk-free rate of 10% per annum. Understand one thing very well. Your strategy was to buy the share in the spot market. Obviously, to buy the share you will need money, and this money you have to arrange by making sufficient borrowings, and this borrowings will be raised from money market for 1 year period at the given interest rate of 10% per annum. Then second step will be to buy the share in the spot market utilizing the same amount that you have arranged through borrowings, that is buy the share at the current market price of rupees 400. Step 3 will be to enter into futures contract with short position, that is to sell at a contracted price of 460. Don't ever forget, your strategy started from this point, right? That is to sell in the futures market. Selling in the futures market means entering into a futures contract with a short position. Now once you have performed these 3 steps at the beginning of the year, you have to now simply wait for 1 year. All the positions that you have opened up, you will have to gradually close each of these one by one. You have to settle each of these contracts one by one. So what happens after 1 year is honor the futures contract and sell the share at rupees 460. My friends, in the previous session I have explained you that if you enter into a futures contract by a short position, no matter what happens, you will be able to sell the share at the contracted price. We have learned this as a very important example in the last part of the first lecture. Then what do you do? Step 5, repay the money market borrowings with interest. So what you have borrowed was 400, with interest what you have to repay is 440, and what you find, step 4 was giving you an inflow, step 5 is an outflow. Difference between these two will be your arbitrage gain. So arbitrage gain will be inflow as per step 4 minus outflow as per step 5. 460 minus 440, that gives you an arbitrage gain of rupees 20. Please take note of this part of the solution. Alright friends, moving ahead to the next scenario, the next case, when actual futures price is given as rupees 420. So what we find in this case, again an arbitrage opportunity exists because actual futures price is still not matching with the fair futures price. This time we find that AFP is less than FFP. Because the actual price is less than the fair futures price, we identify that the stock is underpriced in the futures market. Something which is underpriced, obviously you would want to buy. Therefore, it is better to buy the stock in the futures market. Because you have agreed to buy the share in the futures market, in the spot market you have to take a counter position. So to take that counter position, you should sell the shares in the spot market. So arbitrage strategy will be sell spot and buy futures. Quickly note down this whole thing and then I take you ahead. Alright friends, you would have finished writing this whole thing. So we continue writing the solution ahead and we begin with the arbitrage process. The first step will be short sell the stock in the spot market at rupees 400, which means borrowing the stock for 1 year and selling the same borrowed stock in the spot market at rupees 400. This is what we call as short selling. Now you have 400 rupees in hand. What you will do with this money? Simply in step 2, invest rupees 400 in money market at risk-free interest rate of 10%. So what you get at the end of the year in hand as return of this investment will be 440 as a payback of this investment made today. Now what happens? Simultaneously perform one more thing, that is enter into futures contract with a long position, that is to buy at a contracted price of rupees 420. So understand one thing, here we have decided to buy in futures market. Buying in futures market means to enter into a futures contract with a long position. Friends, before I take you ahead, quickly note down this much. Alright friends, you would have finished writing this. The process ahead would require a waiting period of 1 year. So what happens after 1 year? You realize your investment from money market, which will have a maturity value of rupees 440, and then what you do is honor your futures contract and buy the share at rupees 420. This is called buy to cover, which is to exit the position of short selling. The purchased share at rupees 420 will be given back to the stock lender, that is from the party from whom you have borrowed the stock at the beginning of the year. And the last step will be the arbitrage gain calculation, which will be inflow as per step 4 minus outflow as per step 5. 440 minus 420 will give you rupees 20 as arbitrage gain. So friends, note down this also, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. So let us do one thing. Let us move ahead and discuss the next concept, that is about continuous compounding. Now what exactly is continuous compounding and why are we talking about this? First of all, this whole concept of arbitrage is dependent upon the pricing of the futures contract, and the pricing of the futures contract will depend upon the frequency with which the interest is compounded, whether the compounding is done on annual basis or half yearly basis or quarterly basis or monthly basis or even daily basis, or is it a continuous compounding. So friends, what I would suggest you is, please follow this notation over here. It is F equals to P into e raised to RT, and P will be F divided by e raised to RT. So P will be basically F into e raised to minus RT. Now what all expressions do you find over here? I will explain this through certain examples. So let us do one thing. Let us first understand the concept of compounding of different types, that is half yearly compounding, quarterly compounding, monthly compounding, and so on, and finally land up to what we call as continuous compounding. When I take you there, I'll explain you all these notations. So let us do one thing. Let us take up a calculative question in this regard, and that would be question number 2. Let us see what is given in this question. Principal amount is given as rupees 1 lakh, rate of interest is 21.9% per annum. Calculate the amount receivable at the end of second year if interest is compounded annually, half yearly, quarterly, monthly, daily, and continuously. So you have been asked to calculate the maturity value in 6 different scenarios. Let us begin with the solution. So first thing, if interest is compounded annually, you would simply say F equals to P into 1 plus I raised to N. In this equation, F indicates the maturity value and P indicates the present value or the principal amount invested. 1 plus I raised to N indicates the interest factor. So 1 plus I stands for interest rate and N stands for number of years. In our case, the rate of interest is 21.9% and the period involved is 2 years. So it will be 1 lakh of principal, and 1 plus 0.219 raised to 2 becomes the interest factor. When you compute this, what you get is simply 1,48,596. This will happen when the interest is compounded on an annual basis. As all these calculations are already given as part of the solution to this question that is printed in your textbooks already, you need not bother to write, just go on understanding this whole thing. So, let us deal with the next scenario, that is if interest is compounded on half yearly basis. So, what we do this time is we will continue to take P as the principal amount invested, and instead of 1 plus I raised to n, it will be 1 plus I by 2 raised to 2n. Now, what happens over here? The period involved will be doubled up because the compounding is done on half yearly basis. So, in every year there will be 2 half years. Because the time involved is n years, the total number of times the interest will be compounded will be 2n times. On the other side, the interest rate will be divided by 2. So, in the given example where interest rate is 21.9% for the year, what we will do is we will divide 0.219 by 2. This becomes the interest element for the half year, and 1 plus this half yearly interest element becomes the factor, and this factor will be raised to 2 multiplied by 2, because in total there will be 4 periods of compounding, 2 years, and each year the compounding is done on half yearly basis. So, there will be 4 half years in total, that makes it 2 into 2 as the exponent value. So, finally what we get is 1 lakh into 1 plus 0.1095 raised to 4. When you solve it, what you get is 1,51,534. So, you see one thing, the moment the frequency of compounding is altered, the maturity value is different. The maturity value in case 2 is higher than what you have seen in case 1. So, likewise, if we go with the next part of compounding, which is given on quarterly basis, what we do is if interest is compounded quarterly, this time there will be 4 times in the year where the interest will be compounded. So, f equals to p into 1 plus I by 4 raised to 4n. So, if you can see, when I say quarterly compounding, it will be compounding as 4 times within the year. So, I is divided by number of times the compounding will take place within a year, and that same 4 will be multiplied to the number of years, so that it makes it effectively 4 times the total number of period involved, because compounding will be done 4 times within a year. So, here the period involved is 2 years, and in each year the compounding will be done 4 times. The total frequency of compounding over the entire investment period will be 4 multiplied by 2, that is 8 periods. So, it will be 1 plus 0.219 divided by 4 raised to 4 into 2, that is 8. When you solve it, what you get is 1 lakh into 1.05475 raised to 8, and finally the maturity value comes to rupees 1,53,178. So, my friends, the way I have explained you half yearly and quarterly compounding, exactly on the same basis you can understand the monthly and daily compounding given in 4th and 5th part of the question. What I am trying to do now is directly taking you to the 6th part and explaining you the impact of continuous compounding. Alright, moving ahead, we go to the last part, that is if interest is compounded continuously. Over here the equation will be f equals to p multiplied by e raised to rt. P remains the present value, that is the principal amount invested, and e raised to rt is the interest factor. In place of 1 plus I raised to n, what we have seen in annual compounding, 1 plus I raised to n was the interest factor, and here e raised to rt becomes the interest factor. So, this factor when multiplied to the present value, what you will get is f, that is representing the future value. Now, let me explain you what is this E, R and T. R over here represents the rate of interest and T indicates the time in years. Now, what about E? E stands for exponential value, and E has a constant value in mathematics. E is a constant having a value of 2.71828. So, what happens? E raised to anything can be identified from the table given at the back of your textbook. You can find any value of e raised to something from that table. So, what we find over here is the principal amount is 1 lakh and e raised to RT. So, 1 lakh multiplied by time is 2 years and the rate of interest is 21.9%. So, 0.219, and when you multiply 2 into 0.219, what you get is e raised to 0.438. As I have just mentioned, e raised to 0.438 cannot be determined on your ordinary calculators. You have to refer to the table given at the back of your book, and most cases in examination the value of such exponential figures will be given to you in the question itself. So, here in this case e raised to 0.438 is given as 1.5496. When this multiplied to 1 lakh, you get f equals to 1,54,960. As I have just mentioned, in most cases in examination this kind of table value of E will be given to you in the question itself. Otherwise, a table will be provided through which this can be referred. In a separate video, I will also show you how to calculate this by an approximation, but that would be a last resort. Mostly if the table value is given in the question or the table is given to you for reference, you should refer to that table and find this value. My friends, as I have just mentioned, you need not write up all this. Everything what you find on screen is given in your textbook already. Let us analyze one more important factor. What we have seen in the equation earlier, f equals to p into e raised to RT. So, f indicates the future value, p is the present value or the principal amount invested, and e raised to RT is the future value factor or the interest factor. So, obviously, when this future value factor multiplied to present value, the result obtained is the future value. So, through this equation, if I have to find the present value, obviously what can be done? By cross multiplication, p equals to f upon e raised to RT. So, what happens? Future value when divided by e raised to RT, you get the present value. And you know one thing friends, f upon e raised to RT can be actually f multiplied by e raised to minus RT. As a result, the final equation what we get is present value equals to future value into e raised to minus RT. In the E table, you will find e raised to x values as well as e raised to minus x values given to you. Let us deal with some more examples to understand this concept much better. So, let us take up question number 3. Mr. X gave a loan to Mr. Y amounting to rupees 1 lakh with continuous compounding interest rate per annum of 12% for 3 months. What is the maturity value? And table value of e raised to 0.03 is given to you in the question itself. So, what we have to do now, the question gives you the present value, the rate of interest and the time involved, and we have to simply find the maturity value or the future value. So, what we do to write up the solution, maturity value will be p into e raised to RT. You know this is what we have learnt earlier also. So, present value or the principal amount invested is 1 lakh and e raised to RT, R is 12%, that is 0.12, time involved is 3 months. By mistake you should not write up 3 over here because the time has to be expressed in years. As a result, what we have written over here is 3 by 12. That will be 1 lakh into e raised to 0.03, and e raised to 0.03 value is given to you in the question itself. So, substituting that value, that is 1.03045, the maturity value what we get is 1,03,045. So, my friends, quickly take note of this and then we move ahead. Alright, let us move ahead. and deal with the next question, that is question number 4. What is given over here? Mr. B is going to receive rupees 8,000 on Infosys stock in 3 months time from now. He would like to know the present value of the dividend if risk-free continuous compounding rate is 16% and table value of e raised to minus 0.04 is given to you as 0.96079. So in this case, the question is giving you a future cash flow and asking you to find the present value of this cash flow. What we basically require is the time involved and the interest rate. Both of these are given to us, and the question has also informed you the table value of e raised to minus something. So let us do one thing. Let us see how to put up the solution. Present value will be future cash flow into e raised to minus RT. We have discussed this just a few minutes back. Future cash flow in our example is 8,000. Rate of interest is 16%, so we have to take minus RT. So negative 0.16 into time is 3 months, so 3 by 12. 3 by 12 when applied to 0.16, what you get is 8,000 into e raised to negative 0.04. E raised to negative 0.04 is given to you in the table as 0.96079, and this information is available in the question itself. When you multiply this to 8,000, the present value what you get is rupees 7,686.32. So friends, quickly take note of this and then we move ahead. Alright friends, I am sure you would have finished writing this whole thing. Now I would say whatever we have discussed by far would be simply considered as a background or the ground concept clearing. So basically, if you can link two things, the concept of arbitrage would require the arbitrage process that we have done through the initial question, and then the application of the concept of continuous compounding. So pricing the futures would involve both of these concepts what we have covered by far. So questions that we have done by far, you cannot expect questions like that coming in exam, but this will serve as a basis for learning the real concept ahead. So concept ahead, if I take you further, I would say it will be concept number 8, that is arbitrage through futures. Now friends, over here in this part, we will have 5 different scenarios, 5 different situations of pricing the futures contract. Basically, once you understand how to price the futures contract, then it is all about dealing with how would you compare the actual price and fair price. Actual price can be less or more than the fair price. In such case, we would say in the futures market, the stock is underpriced or overpriced, etc. However, if we are not finding any difference between the fair price and the actual price, we would simply say there is no arbitrage opportunities. So 5 situations. Let me see what all situations we can cover in this class over here in this discussion. So let us begin with these situations one by one. So let us deal with the first situation over here, that is securities providing no income. Now friends, this could be a case where the company in which you are investing does not distribute any dividend, or say you are trying to deal with bonds which are zero coupon bonds or deep discount bonds where there is no income element involved. In such case, determining the fair future price is a very simple task. We have just learned the concept of future value using continuous compounding. S0 indicates the spot price, that is the present value, multiplied by e raised to RT. E raised to RT is the future value factor or the interest factor. When this factor applied on the present value, what you get is the fair futures price. So we can write the definition of these variables. F stands for fair futures price, S0 is the current market price, R is the rate of interest, and T is the time remaining for maturity, and you should not forget that T is always to be expressed in number of years. My friends, what you find on screen is again given in your textbooks, so there is no need to write up this. let us practice a question linked with this situation. So we have question number 5. Let us read this question. X Limited, a company that historically has not paid any dividend and has no plans to do so in the future, is currently being quoted at the Bombay Stock Exchange at rupees 60. You wish to enter into a futures contract on this stock maturing in 3 months' time. If the risk-free rate of return is 8% per annum continuously compounded, what do you expect the futures price to be? If the futures contract were priced at rupees 64, what action would you take? In case it is priced at rupees 60, will your decision change? And the table value of e raised to 0.02 is given to you in the question as 1.0202. So friends, we find one thing very clearly over here, that the current market price of the stock is given. We have been given the maturity value of the futures contract, that is 3 months, and we have also been given the rate of interest on continuous compounding basis. We have been also informed the actual futures price. So to formulate the arbitrage strategy, what we need to do is we need to determine the fair futures price. Determining fair futures price would simply require this first situation what we have learned, because this company does not pay any dividend at all. So this is classified as securities providing no income. So let us understand how to present the solution. So when you have to write up the solution, first you calculate the fair futures price and you write the equation for fair futures price as a spot price into e raised to RT, and explain the variables when you are writing up the solution. Once you have defined all these variables, you may substitute the values. So I want you people to quickly note down this and then I take you ahead. Alright friends, let us move ahead. FFP, it is 60 into e raised to 0.08 into 3 by 12, that is e raised to RT will be e raised to 0.08 into 3 by 12. So now it is 60 into e raised to 0.02. Simply 8% into 3 by 12 will make it just 2% effectively. So it is e raised to 0.02, and e raised to 0.02 value is given in the question already. So 60 into 1.0202, and what you get is FFP as 61.212. So you may write up fair futures price as 61.212. Quickly note down this and then we move ahead. Alright, moving ahead, this is the fair futures price what we have computed, and in the question they have informed the actual futures price, and not one but two different situations given to you. So the first thing what is informed, if AFP equals to rupees 64, it is considered that the share is overpriced in the futures market. You will compare 64 with 61.212. So 61.212 is less and 64 is more. So the actual price being more, we say that the stock is overpriced in the futures market, and for making the arbitrage gain, the investor should adopt the strategy as. Can you think what is going to be the arbitrage strategy? Think. If you have learned the basic concepts rightly, you would have already guessed the answer over here. So anyway, I'll tell you what you have to do. Because it is overpriced in the futures market, you are going to sell it, and so in the spot market you will have to take a counter position, that is buy in the spot market and sell in the futures market. So your arbitrage strategy will be buy spot and sell futures. The next thing given to you is what will happen if actual futures price is 60. So if AFP equals to rupees 60, it is considered that the share is underpriced in the futures market. For making arbitrage gain, the investor should adopt the strategy as sell spot and buy futures. Being underpriced in futures market, you should tend to buy in futures market, and taking counter position in spot market, you should plan to sell spot. So your arbitrage strategy in the later part will be sell spot and buy futures. My friends, quickly take note of this and then we move ahead. Alright friends, let us move ahead to the next situation. Situation 2, that talks about securities providing known cash income. You will take the equation as F equals to S0 minus I0 into e raised to RT. So basically what we have learned earlier, it was simply S0 into e raised to RT. Additional thing what you are doing over here is the present value of dividend you are subtracting from the current market price. So define all the variables. F is the fair futures price, S0 is the current market price, I0 is the present value of dividend receivable, R is the rate of interest, and T is the time remaining for maturity. Let us see application of this through question number 6. So question number 6 is talking about shares of Z Limited is quoted in the market at rupees 40. That means this is S0. A 6-month futures contract on 100 shares of Z Limited can be bought. The risk-free rate of interest is 12% per annum continuously compounded. Z Limited is certain to pay a dividend of rupees 2.5 per share 3 months from now. What would be the value of the futures contract? If the futures contract is priced at rupees 4,100, what action would follow? If it is priced at rupees 3,800, what would you do? And they have given table value of e raised to minus 0.03 and e raised to 0.06. So friends, let us first understand the whole scenario. We have been informed that the company is certain to pay a dividend after 3 months. That means this is purely a situation 2 question where a definite amount of dividend will be received after a definite point of time. Observe one thing, that the futures price is given as 4,100 and the current market price of the share is given as 40. Obviously, something whose price is 40 cannot have a futures price of 4,100. This 4,100 is because of this 100 shares. That means the lot size being 100 shares in the contract. The price is given to you not for a single share but for 100 shares. As a result, you are not supposed to alter the actual prices quoted. So the fair prices should be brought in line with the actual prices. So fair price will also be determined for the lot of 100 shares. So let us see how to put up the calculations in the solution. First of all, we write up the equation F equals to S0 minus I0 into e raised to RT and define all the variables. F is the fair futures price, S0 is the current market price, I0 is the present value of dividend receivable, R is the rate of interest, and T is the time remaining for maturity. Friends, quickly note down this and then I take you ahead. Alright, let us move ahead and substitute all these values. We first find the present value of dividend. So I0 will be dividend amount multiplied by e raised to minus RT, and now this will be, because we have to make calculations for 100 shares, per share dividend is 2.5, we have taken the total dividend as 2.5 multiplied by 100. Now one very important thing, the time involved over here should not be the maturity value of the futures contract. This time is the time for which the dividend income is expected to be received. That means here this will be a 3 months time by end of which you are going to receive dividend. So be very sure when you are dealing with a case like this, dividend into e raised to minus RT, time period involved over here should not be the time remaining for the maturity of futures contract, it should be the time for which the dividend is expected to be received. So when you apply this, it will be e raised to minus 0.03 and whose table value is already given to you in the question. You simply multiply that given value, that is 0.97045 into the dividend amount to arrive at the present value of dividend, which is 242.6125. So when you get the dividend amount converted to its present value, that is I0 has been determined, you are ready to arrive at the fair futures price using this equation, that is S0 minus I0 into e raised to RT. The time taken over here, the time factor considered in this equation will be obviously the remaining time for maturity of the futures contract, that is 6 months in the given case. So 4,000. Now why we have taken 4,000? Per share price was 40, but the lot size of the futures contract is 100 shares, and more importantly the actual futures price is not given for individual share, it is given for the entire lot size of 100 shares. So S0 will be for 100 shares, that is 4,000. This dividend is already for 100 shares, that is 242.6125, what we have just computed over here, multiplied by e raised to 0.06. When you take the values given within the bracket, it gets the net amount of 3757.3875, and e raised to 0.06 is given to you in the question as 1.06184. Finally, the fair futures price comes to 3989.75, which we have written down over here. So friends, quickly take note of this and then I take you ahead. Alright, moving ahead. Now this fair future price will be compared with the actual futures price given in the question to formulate the arbitrage strategy. Now friends, I don't have to explain you that again and again, as in how to do that, you know it very well. So let us see. You have been given two different prices. One of the actual future price is 4,100, against that fair futures price of 3989. When you compare the actual price, it is definitely more and it is considered overpriced in the futures market. So in the futures you should sell, so in the spot you should buy. So your strategy formulated will be buy spot and sell futures. On the other side, the other price given to you is 3,800. When it is 3,800 compared with 3,989, which is the fair futures price, this 3,800 is low. That means this is underpriced in the futures market. So in the futures market you should buy, and counter position in the spot market should be to sell. So your strategy formulated is sell spot and buy futures. Quickly take note of this and then we move ahead. Alright friends, let us move ahead and deal with the third situation. Situation 3, where securities are providing a known yield f equals to S0 into e raised to r minus y into t. So as I have just explained, r stands for the rate of interest prevailing in the money market and y stands for the yield. So in the example that I have just given you, if you have borrowed from money market at 12% and the security is providing you the yield of 8%, so you borrowed at 12% and you are earning 8%, so net interest cost that you incur will be just 4%, 12 minus 8, that is 4%. That's all what you have to do differently over here. So let us write up the variables. F is the fair futures price, S0 is the current market price, R is the rate of interest prevailing in money market, Y is the yield rate on security, and T is obviously the time remaining for maturity of the futures contract. So to deal with this situation, let us take up a relevant question, that is question number 7. Let us read what is given over here. If NJ Limited provides a dividend yield of 4% per annum, the current value of stock is rupees 500 and the continuously compounded risk-free rate of interest is 8% per annum, what would be the value of a 3-month futures contract? If the futures price is rupees 510, what action would follow? Will the position change if the price is rupees 490? Table value of e raised to 0.01 is given to you as 1.01005. Let us analyze what is given as information in the question. This is the rate of interest prevailing in the money market, that is R, and this is the yield rate on the security, that is Y. So R minus Y, that is 8% minus 4%, will give you again the net cost of 4%, which you will apply as e raised to R minus Y into T, and this is the spot price given to you, that is S0, and time remaining for maturity is 3 months. and then the actual futures prices are given, two different prices are given, that is 510 and 490. So let us see how to present the solution. So we first write up the equation and define all the variables. I have already explained you this equation and all these variables, so just quickly take note of this and then we move ahead. Friends, writing such equation and defining all the variables as part of solution is compulsory, don't skip that. Alright, let us move ahead. Once you have written the equation and defined all the variables, time for us to substitute all the given values in these equations. So in the equation, what you simply do is S0 is 500, e raised to R is 8%, R minus Y is 4%, and time remaining for maturity is 3 months, but we have to write it in terms of number of years, so written as 3 by 12. So when you take, this will be 0.04 net into 3 by 12 will finally give you e raised to 0.01, whose value is given to you in the question as 1.01005 multiplied to 500 gives you 505.025. So we can declare fair futures price is 505.025. So please take note of these calculations and then we formulate the arbitrage strategy. Alright friends, let us move ahead. We have been given two different actual prices, that is the prices given for the futures contract. So the first price given is 510. If the fair futures price is 505 and the actual futures price is found to be 510, obviously it is considered overpriced in the futures market. So in the futures market you would sell, and taking counter position in the spot market you would buy. So your arbitrage strategy will be buy spot and sell futures. On the other side, if the price quoted is 490, in the futures market we would say that the stock is underpriced, so we should buy in the futures, taking counter position we should sell in the spot market. So arbitrage strategy will be sell spot and buy futures. Please take note of this also, and that will be end of the solution. Alright friends, you would have finished writing this whole thing. Now one thing that I would want to further tell you is that what we have done by far is covered up the initial three situations. The initial three situations were dealing with securities. The later two situations deal with commodities. So we are stepping into futures, or I would rather say arbitrage using futures contracts, not for securities but for commodities. So here we are stepping into commodity derivatives. So what I would do is I would write up the next heading as situation 4, that is carry type commodities. So just pay attention on the screen and let me explain things ahead with respect to carry type commodities. Carry type commodities, pay attention to this line. When carrying cost is given as a certain future cash flow. So in that case what you are going to do, I have just explained to you, F equals to S0 plus C0 into e raised to RT. You would define all these variables, what I have already explained to you. S0 is the current market price and C0 is the present value of carrying cost. R is the rate of interest and T is the time remaining for maturity. So friends, this you don't have to write, it is given in your textbook already. Let us move ahead and understand the application of this concept. We take up question number 8. What is given over here? Consider a 6-month gold futures contract of 100 grams. If the spot price is rupees 600 per gram and that it cost rupees 3 per gram for a 6 monthly period to store gold, and that the cost is incurred at the end of 2 months. If the risk-free rate of interest is 12% per annum continuously compounded, compute the futures price. If the futures were available at rupees 660, what action would follow? Would the position change if the futures were available at rupees 620? Table value of e raised to minus 0.02 and e raised to 0.06, both are given to you. So let us first analyze the question. What is given over here? The lot size is 100 grams of the gold and this is the spot price S0. It would cost rupees 3 to carry the gold and this is payable after 2 months. So friends, we cannot directly add 3 to 600. You should understand that 3 is payable not today but after 2 months. So this 3 will be converted to its present value over a 2 months period and the present value of 3 will be added to the spot price. So it will be S0 plus C0. So this present value added to spot price becomes the base cost, that is S0 plus C0, and then multiplied by e raised to RT. That time rate of interest is given as 12% and then the T that you consider for computing FFP, that is fair future price, will be a 6-month period. You should understand, for computing the present value of carrying cost you should apply 2 months and for computing fair futures price you should apply 6 months time, and that is why table value of e raised to minus 0.02 as well as 0.06, that is e raised to 0.06, both are separately given to you. So let us understand how to present the solution. First of all, you would write the equation f equals to S0 plus C0 into e raised to RT. Define all the variables as I have already explained to you, and friends, again and again I am telling you one thing, that you should not avoid writing all this as part of solution. It is mandate for you to write up this. Quickly take note of this and then we move ahead. Alright friends, let us move ahead. What we find next is the substitution of all these values in the equation. So we will first find the value of C0, that is cost multiplied by e raised to minus RT. Rate of interest will be 12%, but time involved over here, as I have told you, should be 2 months. So it will be e raised to negative 0.02, value of which is given to you already, that multiplied to 3. The present value of carrying cost comes to 2.94. Substitute this 2.94 in the equation of fair futures price and what we get is 600 plus 2.94 into e raised to RT. This time T will be the factor of 6 months. So 602.94 into e raised to 0.06. E raised to 0.06 has been given as 1.06184. The final value what you get is 640.23. So your calculation of futures price, that is fair futures price, is ready. Please take note of this and then we move ahead. Alright friends, let us move ahead. After making calculation of fair futures price, you would compare the futures price, that is actual futures price which is given to you. The first price given to you is rupees 660, which is greater than the fair futures price that we have computed, and so we find that the gold is overpriced in the futures market, and so in the futures market it will be better to sell. So in the spot market you should preferably buy. So the strategy will be buy spot and sell futures. If the contract price is 620, which is the other price given to you, you should take the inverse strategy, that is sell spot and buy futures. Quickly take note of this also and then we shall move ahead. Alright friends, let us move ahead. What we do now is deal with a very similar type of situation, that is still carry type commodities, but a little difference over here, that is carrying cost is given in terms of percentage. Even this I have explained you very well some time back. So the equation over here will be F equals to S0 into e raised to R plus C into T, and you may just define all the variables used over here, and all this is given to you in the textbook, so you need not write up this. When we have to solve a question relating to this, obviously we will write up all this stuff. So let us deal with question number 9. Consider a 6-month gold futures contract of 100 grams if spot price is rupees 600 per gram and it costs 6% per annum continuously compounded for a 6 monthly period to store gold. You see, this time carrying cost is given as 6% and 6% is given again as 6% per annum. So, we have 6% per annum as carrying cost and risk free rate of interest is given as 12% continuous compounded. Compute the value of futures price, and then 670 and 640 are the two different prices given to you, and table value of e raised to 0.09 given to you. So, let us see how to solve this question. We have just learnt the application of fifth situation, that is f equals to S0 into e raised to r plus c into t. Let us apply the same. So, this is the equation, and here you have to define all these variables. F stands for fair futures price, S0 is the current market price, R is the rate of interest based on continuous compounding, C is carrying cost given in percentage, and T is the time remaining for maturity. Quickly take note of this and then I take you ahead. Alright friends, let us move ahead. Once we have written this equation and defined all the variables, let us substitute all the values in the equation, and what we get is 600 into e raised to 0.12 plus 0.06, that is e raised to r plus c, and then r plus c will be multiplied to t, that is 6 by 12. So, what we get finally is this will be 12 plus 6 18% into 6 by 12 will become 9% effectively. So, this whole thing will become e raised to 0.09, and we get 600 into e raised to 0.09, and e raised to 0.09 value is given to you already in the question as 1.09417. What you get as a fair futures price is 656.50. So, once we have got this, then we can formulate the arbitrage strategy. Quickly take note of this and then I take you ahead. Alright friends, so let us move ahead and deal with the arbitrage strategy formulation. So, you have been given the first price as 670. The moment you find that the price is 670 quoted in the futures market, it is obviously indication of overpricing, and so it is better to sell in the futures market, and contrary, you make a long position in the spot market, that is buy in the spot market. Your strategy will be buy spot and sell futures, and if the price is given as 640, you would just make a reverse strategy, that is sell spot and buy futures. Quickly take note of this, and that will be end of the solution. Alright friends, I am sure you would have finished writing this whole thing. Now, if I can just tell you what we have discussed in this class, it was all about arbitrage through futures. All 5 situations that we have discussed are important, and the later 2, as I said earlier, it is dealing with commodity derivatives. So friends, what we will do is we will take the discussion ahead with the upcoming parts. However, let me put an end to this part, declaring this as end of part 2. Thank you so much for attending this class.